You may have seen recent headlines comparing today's AI-driven market to the late 90s dot-com era. While we take historic comparisons seriously, I'd like to outline what's different about today, what still deserves caution, and most importantly, how we're positioning our strategies to hold up across a range of outcomes. Let's talk valuations. Stock prices have climbed, and by simple measure of price versus earnings, the market looks more expensive than its long-term average. However, it's also true that the broad market remains below the most extreme levels reached in the late 90s. You can see this in the valuation charts that track the relationship between price and earnings over time. Back in the dot-com era, in Barron's Magazine's March 2000 issue, there was an article called Burning Up. They reported that 74% of 207 publicly traded internet companies had negative cash flows, and at least 51 of those companies was projected to run out of money in the next 12 months. In contrast, today the largest part of the markets are producing real earnings, and overall profit margins across the major U.S. index have remained above their 5-year average. That doesn't remove risk, but it does mean prices are supported by business results that we didn't see from some of the companies in the dot-com era. They just had way too much debt. Skip ahead to today. AI isn't just a concept. There are heavy investments behind it. There are a number of companies involved in the build-out of the plumbing for AI. Data centers, processing chip manufacturers, software, and power supply. You can see this in the government data, which shows manufacturing construction near record highs, much of it related to chip facilities and an increased business spending on information processing equipment and software. Those are real dollars going into real plants, servers, and the tools that will support future productivity. Let's shift to other headlines. The Federal Reserve. On October 29th, the Fed lowered interest rates for the second time this year and said it will stop shrinking its bond holdings on December 1st. That combination appeared to ease some pressure in financial markets without being a promise to keep cutting short-term rates. The message was that conditions warranted a modest step, and from here, the Fed repeated that they will continue to make future changes based on data. Let's take a second to talk about the government shutdown that appears to be ending. Government shutdowns do create uncertainty and lots of media coverage. Historically, markets have often overlooked them. Returns during past shutdowns have been mixed, and many episodes have had flat to slightly positive returns. That's not a forecast, just context that short-term political moves haven't reliably driven long-term market outcomes. Our job is to make sure you and your overall approach remain on track. We continuously track a variety of indicators, including earnings trends, profit margins, credit conditions, employment levels, and inflation, just to name a few. We try to be forward-looking, and we adjust our approach when the facts change. If you'd like to meet and discuss how your portfolio is positioned for both stronger and more challenging environments, I'll put a link to our website in the description so you can reach out to us and schedule a meeting.